Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. My name is Sumit Roy, and I'm Senior Analyst for ETF.com. This week, we're talking with Dhruv Nagrath, Fixed Income Product Strategist at BlackRock. Dhruv, great to have you on the show.
Thanks for having me, Sumit.
Absolutely. So I want to start at a macro level, Dhruv, since I have you on the day that the government released the CPI report. And it looks like the CPI report was a little bit better than feared. It was exactly on expectation, 0.3% month over month increase in the core CPI. What's your take on the inflation report?
Yeah, thanks a lot, Sumit. Appreciate you asking that question because it is really the question on everyone's lips right now. There's a hyper focus on almost every inflation reading, especially if you recall the inflation readings for Q1, all were higher than expected, higher than markets were expecting. So inflation was proving to be stickier than expected. This reading is probably a welcome print because it is a step in the right direction, but is not enough for cuts just yet. So, one of the things that we are seeing as a persistent theme is the ongoing kind of stickiness of services inflation, whereas there has been progress on goods inflation, right? So that's a recurring theme. I think markets will be, you've definitely seen it in market performance today. Markets have been encouraged by this inflation reading. But as we've been talking about, at least with our clients, we've been mentioning that this path to where the Fed wants to be in terms of inflation is going to be a little bit of a bumpy ride. So we are being very focused on the data, being data dependent. I think coming into this year, markets got a bit ahead of themselves and then repriced. I think overall it was an encouraging reading, but nothing to immediately say there's all the cuts that were coming in, that we were expecting that the markets were expecting at the start of the year. They're not suddenly back on the table. And then the other thing worth pointing out is that we did also have a retail sales number that was a little bit weaker than expected, and that is encouraging in the sense that a bit of that heat in the economy might be coming out. So overall, an encouraging number, and you've definitely seen. We don't encourage reading too much into one-day performance of risk assets, but risk assets definitely seem to like that today.
And Dhruv, you mentioned that the high inflation readings during the fourth quarter, they added a little bit of bumpiness to markets. Do you think that's all that they were? They were just a bump in the road towards, 2% inflation. We're going to start, seeing these kind of softer inflation prints now as we head throughout the rest of the year?
We don't think it's going to be a straight line, Sumit. I think there are some interesting dynamics in the economy to do with demographics, supply and demand conditions. The impact of what we've got is a really strong job market, and that's been supplemented by strong hiring in certain sectors, and then also immigration that has supported that job market, right? So you've got this very strong economy, a lot stronger than everyone was expecting a year ago. But you've also got an uneven kind of market dynamic in terms of some sectors are still kind of humming along, and other sectors are maybe feeling a bit more of the pinch from restrictive policy. So it's hard to say it's just going to be a straight line down to the 2% that the Fed needs to get it to be. And that's why when I say bumpy, ups and downs. So yeah, I think that's kind of that's the view, is that it's not going to be a clear cut view, but we're kind of paying attention to the data and positioning appropriately, right? So earlier in the year, we were saying that it would kind of be the middle of the year when rate cuts might be appropriate, but given that the inflation readings have been stronger than expected, we're now off the view that a September rate cut is more likely. Like I said, in a very data dependent world.
Gotcha. Because I was going to ask you about that, Drew. A few weeks ago when bond yields were really going up and we had just gotten those high readings on PCE and CPI for March, people started talking about the Fed potentially hiking rates rather than cutting them. It sounds like you still think that the Fed's next move is going to be a cut.
Yeah, we do think the next move is going to be a cut. It'll likely be a cut. It may not be a series of precipitous cuts, but Jay Powell effectively told us so a few weeks ago, in a press conference where the other tail of the distribution, the expectations around hikes, were basically uh, talked away by Jay Powell. So we do think the next move is likely to be a cut, and that's in line with the broader trajectory lower of inflation. So a lot of progress has been made on inflation. Um, so that's based on everything that we see. We do think that the next move is likely to be a cut.
Gotcha.
Just
So,
yeah, sorry, it
so
may just be a
Drew,
little bit late expected.
Gotcha. So, Drew, now that we've kind of covered the macro environment, I want to talk to you about fixed income investing. Given everything that you've said, how do you think that investors should be positioning their fixed income portfolios?
Yeah, Sumit, this is a great time. I've heard it described as the golden age, but maybe it's not my place to make such lofty claims. But it is a great time to put money to work in fixed income. And from a portfolio construction perspective, the key message, the most important thing, if any of your listeners take anything away from what I say today, is that you don't need to take a lot of risk to make a decent level of return using just your fixed income, your high quality assets, right? You've got a situation where the entire yield environment in the fixed income markets has been reimagined. Now that was painful 2 years ago in 2022 when we had the fastest hiking cycle in decades, and that was definitely painful for fixed income portfolio holders. But now the opportunity set has been completely reimagined. So, firstly, we do think that investors have a huge opportunity set in fixed income. We have noticed that a lot of investors went to cash. They went to money market funds. We saw over $1 trillion go into money market funds last year, and a lot of those assets have stayed in there. So one of the things that we're talking to clients about is, yes, it has now been okay to put some money in money market funds because their yields have been at a level that is fairly competitive, but reinvestment risk is a real thing, right? So, when the Fed does ultimately start cutting, short-term rates will come down, and you're then going to be reinvesting at lower rates, right? So, one of the things that we've been talking to clients about is there's still a lot of great high quality fixed income yield to be had in the short end of the curve. High quality assets don't really need to go too far down the risk spectrum. That's fine. You can have a very high quality base there. You've got an inverted yield curve giving you healthy yields at the short end of the curve. But now might be a time to be considering adding some duration into portfolios for that reason of reinvestment risk, as well as the potential for price appreciation further along the curve when the impact of rate cuts eventually kicks in. Now, it's important to not try and get too cute about it. If we had perfect foresight on exactly how the market would move, rates market would move, that would be an easy way to make a lot of money. But we don't. Markets can be unpredictable. But we do think that from a portfolio positioning perspective, this is a good chance to start adding a bit of duration into portfolios. We wrote a paper recently called No Time to Yield. And one of the analyses we did in that, we found that this period between the last hike and the first cut is a period where bonds tend to outperform cash by almost 10% on average, looking at past pause periods. And the intuition there of bonds, now being the time to allocate to fixed income, is that markets tend to price in rate actions before they happen, right? So that's why we're talking to clients. But to sum it all up, you asked about positioning in fixed income portfolios, up in quality, the short end of the curve, intermediate part of the curve, like I said, adding a bit of duration. And on an all-in yield basis, we do like high quality credit assets. And there's a lot of different ways to kind of go about that. But let me pause there because I've been rambling a little bit. Sumit, back to you.
No, no, that's great. And that's great color. So, Drew, obviously BlackRock has an extensive lineup of fixed income ETFs, some of them, extending back 4 years. They launched decades ago, and then others that are quite new. And I want to talk about some of those newer ones in a minute. But just looking across your whole lineup, could you talk about, where you're seeing activity? You talked about duration. I know TLT was super popular last year. Where are you seeing investors gravitating?
Yeah, TLT. You're right. TLT was very, very popular last year. It was kind of confounding for a lot of people. They were trying to figure out how is it that it's the number one asset gatherer. I think it took in about $22 billion last year in flows.
Incredible, yeah.
Yeah, which was quite remarkable given what we saw happening in the rates market. This year, it's interesting. Just looking at the flows into iShares fixed income ETFs, we've seen a lot of flows into broad multi-sector exposures like your AGG or your IUSB. These are high quality, core fixed income assets across, they're diversified across treasuries, IG corporates, agency mortgages. Of course, IUSB has a bit of high yield and EM in there, but these are like core and core plus assets. That's where we've seen a lot of flows, about 17 billion. The next category is 6.3 billion into government exposures, right? So government ETFs, treasury ETFs. But the interesting thing I wanted to call out, because those first two categories I called out shouldn't be too surprising. Investors are reallocating back into fixed income markets. Having broad exposures like AGG are a really easy way to do it. You can get exposure to the ag, which is over 12,000 line items for 3 basis points per annum. That's a pretty great deal if you ask me. Of course, I'm biased. But the category that I wanted to call out as an interesting one, maybe something different, the third biggest asset gathering category in our product lineup is term maturity ETFs, actually. So $4.7 billion into term maturity ETFs. And Sumit, I don't know how much your listeners are familiar with this product category, but basically these are bond ETFs that mature on set schedules, on calendar year schedules. And the kind of the intuition here is that a lot of clients have been wanting to put money to work. They've been wanting to try and extend duration, build out bond ladders to term out their rate risk, but they don't necessarily want to keep it in a perpetual exposure. They want to have a certainty around their maturity experience and their exact yield outcome. And so these things have really come to the fore. We've had them since 2010, so it's actually been around for 14 years. But definitely in the past 4 years or so, with like I said, the reimagining of the investment opportunity set in fixed income, this has been a really popular product set. And then continuing the theme, though, really up in quality. Bulk of the flows have gone into Treasury I bonds, so Treasury term maturity ETFs, and then into IG corporates. So that's an interesting theme that I'd call out. Outflows probably not a surprise, but outflows have been from EM debt and from high yield.
That's great. So really interesting to see those inflows into the term maturity ETFs, Drew. Do you think there's any particular reason they're catching on now? Because like you said, they've been around for a while. I've actually been surprised that they hadn't caught on sooner, given that, there's a lot of pluses to these ETFs compared to, traditional bond ETFs. Why do you think they're catching on now?
Yeah, I jokingly call this an overnight success, 14 years in the making with my colleagues. Basically, I think there's two things that come to my mind. One is what I talked about, where there's the opportunity set in fixed income has basically been reset, and it's just a really neat way of putting money to work along the yield curve across different product categories. That's one. But why now as opposed to a decade ago when we first, more than a decade ago when we launched them? I think it's because of the broader adoption of fixed income ETFs as a go-to, really efficient access vehicle for building portfolios. I think that's the real explosion that we've seen. We've seen really exponential growth. Sumit, you mentioned that BlackRock launched the first four fixed income ETFs. It was actually back in 2002. The first $1 trillion took globally in fixed income ETF assets across the industry. That took about 17 years. The second $1 trillion in global fixed income ETF assets came 4 years later, right? So that's the kind of exponential growth that we're talking about. So I think it's also just a product of greater adoption and awareness of the broader category. And then whether it's advisors or individual investors, they're now a lot more aware of what they can do within the fixed income ETF product set, and I bonds term maturity ETFs are a real star of that product set. There's a really neat ladder tool on our website. If you just Google iBonds ladder tool, you can see why it's so simple, and that's I think that's why. Because it's easy. There's a lot of clients who just said, "Yeah, this is the way I'm going to put money to work."
That's great. Now, Dhruv, I want to talk about some of your new ETF launches within the fixed income space. There's about three ETFs that I want to touch on, starting with the BlackRock Total Return ETF, ticker symbol BRTR. Can you tell us what this ETF does and what makes it unique?
Sure. Yeah. Sumit, one thing I'd say before I launch into BRTR specifically is this is part of a broader trend. It has accelerated lately. So BlackRock has a long history of managing active fixed income ETFs. We've been doing it for over a decade. We've got over $10 billion in assets under management, active fixed income ETFs. But what you saw as a product of regulatory change in 2019 with the changes to the ETF rule, it's become easier for a lot of active managers to now launch ETFs. And at the end of the day, the investor wins, right? The investor has much more choice now, both in terms of the wrapper of the assets they use, as well as the investment style. So this is a broader trend, and there are some products that are coming to market that are substantially similar to existing mutual fund strategies, and this particular product to kick off our discussion is one of them, where BlackRock has a very successful core plus mutual fund, existing fund called the BlackRock Total Return Fund. There was a demand from some of our investors to have an ETF version of that, to have an ETF version of an existing mutual fund. So this was launched in December of 2023. So it's relatively recent. It's early days for the fund. It's yielding 5.6%. It's got a duration just under 6 years. And it's got a management fee of 38 basis points, which is it's cheaper than the average ETF and mutual fund in the core plus category. That's a good start because it's a way of giving you access to that kind of core plus category, and it's run by Rick Reeder, who's obviously our CIO, Fundamental Fixed Income. He was the Morningstar 2023 Outstanding Portfolio Manager Award winner, and that's a fund that's the ETF version of an existing $18 billion mutual fund. So that's one of the ways to approach it. But there's been a couple other funds as well that have entered into the active fixed income ETF space as well.
Yeah, and another one of your active fixed income ETFs is the BlackRock Flexible Income ETF, ticker symbol BINC. It looks like this fund launched in May of 2023, if I'm not mistaken. Can you talk a little bit about this one?
Yes, Sumit, this one is actually celebrating its first birthday this Sunday. I didn't get an invite to the party. Hopefully, you will, but if not, we can
Happy
just
birthday to
celebrate.
BINC.
Yeah, yeah, we can celebrate it in spirit. But interestingly, just this week, it crossed just ahead of its first birthday. It crossed $3 billion in assets under management, which Sumit, I've been in the ETF industry for a decade now. That's really remarkable growth for the first year for a fixed income ETF to get that kind of asset gathering. And I've got some theories as to why. At the core of it is the fact that it's a really neat solution for a problem that a lot of clients that I speak to in my job as a portfolio strategist, speaking to wealth managers and investors around the country, is really one of the challenges that they face is that there are certain parts of the fixed income markets that they just don't want to have to be experts in, right? And namely, what I'm talking about here is the sectors that this product, BINC, which I call BINC, we all call it BINC actually, these are the sectors that BINC plays in. And so it's the plus sectors of the fixed income market. So this is designed to be taking risk in the higher yielding sectors of fixed income market, but to do it in a nimble and diversified way. So it's delivered for clients so far. It's obviously just been 1 year, but it's delivered a level of yield that's comparable to double B high yield, but with a much higher kind of credit quality and 30% less volatility, right? So from a total return perspective, it's outperformed all of its major competitors. It's ranking in the 17th percentile for the multi-sector bond category. But the core of, I think, its success is this: it's an easy to use access vehicle for those higher yielding sectors of the market. Things like high yield bonds in the US or in Europe, emerging market debt, AAA CLOs, um, you know, uh, agency, well, actually, agency mortgages come into the core part of the portfolio, but non-agency mortgages or securitized product. These are the things that we just don't, a lot of investors out there don't have the time to be experts in. And so they've been willing to say, we can take advantage of an active ETF in a really neat, efficient wrapper and allocate to that fund. So yeah, it's been really pleasing to see the growth of that fund.
Speaking of CLOs, AAA CLOs, you actually have BlackRock AAA CLO ETF, ticker symbol CLOA. I was really excited to talk to you about this ETF because I've been hearing a lot more about CLOs lately, and there's been quite a few ETF fund launches in the CLO area. Can you talk a little bit about this ETF and what sets it apart from the other CLO ETFs that are on the market?
Yeah, I sure will. Samit, one thing I will say, you previously had one of my colleagues, Danny Prince, on this podcast, and you challenged him to try and say the name of one of our funds, BLCV, in a phonetic way. And he did not take up that challenge, and I won't as well. But I will say phonetically, within the firm, we've been calling CLOA Cloa. I'm probably going to get slapped on the wrist for saying that, but I
I
love
like
calling it
it.
Cloa. It's fun. It's always good to give a personality to these intangible things that we call funds. But look, this is a really neat illustration of the benefits of accessing markets using ETFs, right? So AAA CLOs are a sector of the market that has really matured as a place to source yield with potentially higher yield and lower volatility than traditional fixed income sectors. So very quickly, a CLO is a pool of potentially higher yielding and lower rated loans, where the priority of the cash flows received from those loans and their risk is kind of allocated across different risk and return profiles. It's a process called tranching. So tranches can be AAA, AA, etc., following the same kind of rating style profiles that investors might be familiar with from rating traditional credit. So that's a securitization process where that happens. It's very important to distinguish these from CDOs, which were, as we know, problematic during the time of the crisis. This is a very different market. They're pools of loans. Like I said, they've been tranched into different credit ratings, and they've actually matured to a $1.2 trillion market globally. And in this world, like I said, and by the way, just for a reference point, $1.2 trillion, that's roughly the size of the global high yield bond market, right? So that's the kind of market that we're talking about. And the appeal here is you've got high levels of yield that are floating rate, right? So they reference to floating rates like SOFR. And so that means that there's low duration, right? So right now, CLOA has a yield around 6.8% with an 0.18 year effective duration or interest rate risk that is very, very low, right? And so it offers the potential for higher income with potentially lower volatility because you're cutting out one of those big sources of volatility in your fixed income, which is interest rate risk. And I think that, like I said, this is the benefit of using an ETF as an access vehicle. You're accessing the market, but you're also accessing active management, right? So this is actively managed by BlackRock's global fundamental credit CLO tranche team. We've seen a lot of interest in this sector. This is an environment where, like I said earlier on, we do think eventually the Fed will cut, but as rates have stayed higher for a while, this has been a diversified way of getting a bit of extra yield into a portfolio.
Super interesting ETF. And Dhruv, can you talk a little bit about the difference between CLOA and another one of your ETFs, BRLN, which is the BlackRock floating rate loan ETF? Is it just that BRLN is, a broader ETF, while CLOA is just the AAA tranche within those loans?
Yeah, so I think that's a pretty neat way to kind of think of the differences. CLOs are specific, instruments that are holding packages of loans. BRLN is accessing the broader loans market, so they're playing in similar spaces. But I guess the difference is, with CLOA, it's focusing on that AAA tranche of the market. But BRLN, that's I appreciate you calling it out, because that's been another ETF that we brought to market that is managed by our active management teams. That's performed quite well, as a way of having floating rate exposure in the credit spectrum, for clients who want to get that loan exposure into their portfolios.
So, Dhruv, before I let you go, is there anything else you want to add?
Thanks, Sumit. One thing I'd say, just given that I speak to a lot of investors and wealth managers around the country, a lot of people are asking me about, how do you access the credit markets right now, given where credit spreads are, right? So if you look at investment grade credit spreads right now, when I last looked, about 88 basis points. So that's the additional spread, the additional compensation you get above your risk-free asset, for holding that risky asset, which is investment grade bonds. Similarly, with high yield, we've got 303 basis points of credit spread. Both of these spreads are well inside, i.e., well lower than their longer term averages. So the question for a lot of clients is that means that valuations are tight. And in credit markets, especially when spreads are this tight, it's actually about avoiding losers, avoiding defaults rather than picking winners, right? And so one of the things I just wanted to call out for your listeners is the success of some of our systematic ETFs that use really intuitive screens to outperform and to really, like I said, avoid to try and avoid defaults, right? So they try and screen out the riskier issuers using a systematic process, using a probability of default model. And then from that pool of higher quality assets, they then tilt towards those issuers that have more attractive valuations relative to the market. So the tickers there are IGEB and HYDB. Both of them have crossed the 500 million mark. I think IGEB is close to 680 million. And they've basically been, over the past 5 years, they've been top decile performers across their Morningstar categories, while having some of the lowest fees in their categories, in their the IG and high yield categories. So neat one to just take a look at, because of what I'm hearing from clients, which is maybe a reluctance to allocate to credit markets given the tightness of spreads. Having something that lets you screen out the riskier issuers and then tilt towards the undervalued issuers might be a neat way to play it. So that's my little throwaway comment for you, Smith.
Awesome. Well, fantastic, Dhruv. We're going to have to leave it there. You gave us a ton of great insight. Thanks so much for your time. Listeners, I hope you enjoyed this episode. You can find this and all other Exchange Traded Fridays episodes on ETF.com or on any major podcast platform. See you next week.